Well, greetings, my beloved clients and friends. Today is July 13th, and the inflation numbers, or CPI, came out this morning. And we wanted to give you an update on that, as we've been talking about it and how we'd be keeping a close eye on it. And the news was not good. It came out really bad. So the year-over-year increase in the CPI was 9.1%. which was higher than it had been and higher than they had anticipated. And the month-over-month number was 1.3%. Again, higher than it was the previous month and higher than they had anticipated. So it was just really hot. I mean, 1.3 month over month on an annualized basis is 15%. So we said we had been looking at the price of oil, and it peaked in the middle of June. So it got up to $123 a barrel June 13th. So basically half the month oil was higher, and then about half the month it was lower. So it ended lower, but it didn't really benefit in terms of the prices. Now, right now it's around $95 a barrel, so it's off about over 25% from its high just a month ago. So I believe that should impact this month's read. So there are the two biggest factors in the inflation numbers. We've already said one was oil, because it's a big expense, right? Gasoline for consumers, and then for the transportation industry, right? And for manufacturing, and it's just a big input in everything that's made. And so when that's high, it raises the cost of everything. But I want to talk about the other big component of the CPI, and that's housing. But first, let me just talk about what this high CPI means. So it's going to impact Powell, that when they meet this month, which is coming up in a week or so, he's gonna have to raise rates again, and he was already anticipating raising them 3/4, and so he's got to do at least 3/4, maybe even a full percent. So rates are going up. That's the overnight rate. They're gonna be going up. Okay. Yeah, he has to show that he's committed to fighting inflation. Now, so this will be the fourth rate hike this year, and so we're in that rate hike cycle, which there was another big rate hike cycle in 1994, another big one in 1981, again to combat inflation, and there were also ugly periods in the stock market. But after that period of ugliness and successfully containing inflation, they gave way to this long stretch of strong economic and market performance. The 81, 82, that was at the beginning of Reagan's presidency, and then for the rest of his term, I mean, the market did phenomenal, and the economy. And then same thing in 94, when Greenspan raised rates those 6 times. I remember those times and how difficult the reviews were with clients. But it gave way to a tremendous period of growth, 95, 96, 97, 98, 99, a 5-year run of phenomenal economic growth and market performance. So we're toughing it out, man. We've raised our cash. Cash is our biggest position. We're about 30% cash, and so we're being as defensive as we can. And I'm looking for names to sell, but man, some great companies are insanely cheap. It doesn't mean they're not going to get cheaper in in the short term, but some of the names in our portfolio just look incredibly cheap, so it's really hard to pull the trigger to sell them when they're that cheap. That being said, we have sold some of them. So we're just going to do our best to be cautious and on top of this turmoil, and stay focused on having good companies that could endure this difficult times that we're in. And so getting back to housing, which is so the CPI is basically a basket of goods that people consume, and in there is housing, because that's, probably a person's or a family's biggest expense. So it accounts for about 30% of the CPI, or that basket of goods. And so we said that if oil keeps going up, there's not much Powell can do. Same thing, if the price of housing keeps going up, there's not much Powell can do. So I think that's contributing a little bit to that inflation, that the price of housing is stubbornly keeps going up, in particular rental housing. So I want to talk about the possibility of rental real estate, in terms of housing in particular, as possibly a good place to invest, and why. And it boils down to supply and demand. Two things. There's constrained supply, and two, there's heightened demand. So let's start on the supply side first. So after the financial crisis of 2008, which was a big part of that was the housing crash, right? Developers really slowed down. So and that's been, 14 years ago now. So for the last 14 years, not a lower rate of development has been happening on the side of housing. New construction has been slow because developers kind of had their tail between their legs, and bankers were much more cautious in lending to developers. So that slowed down the building of new homes. So there's a shortage of housing nationwide, and in other areas, more particular. So one, there's been this long-term trend of a shortage of housing. Two, now that rates are going up, that shortage of housing will continue. Why? Because it costs more for a developer to get financing for a project. Okay, the banks are still going to be tight, and now the cost of money is going up. So it's gonna put more developers on the sidelines, or make more projects not pencil out, because when you factor in the cost of the capital, it makes it tougher for those deals to pencil out. So that's going to make supply continue to be bad, right? And especially if people fear, if developers fear that the economy is slowing down and all these things, they're going to be even more hesitant to bring on a new supply. A third thing that could constrain supply is that with rates going up, and let's say people are worried about the housing market leveling off or going down, but they have a 3% mortgage. So they're not going to sell their house to go out and buy another one with a 6% mortgage, So it's means there's less people wanting to sell their house. Baby boomers in general didn't want to sell their house, and now with the with the rate situation, even less incentive to sell their house. And there's a lot of people have a lot of equity because of the run up. And there's not a lot of variable loans resetting. So there's not that big fear of a glut of housing supply is going to come on the market. A third thing, so let's say people were concerned about, real estate market is really slowing down, might be topping off, it might be time to take profits. Well, they're not going to do that in the house they live in, but maybe they would on their investment property. Let's say they have a rental. They said, shoot, I have 6 rentals. Maybe I should lighten up a little bit because, this market might turn around. Might as well take my profits now. So if they sell a property that's already a rental property, some of those will be bought by investors that continue making it a rental property, but some of them will be bought by people to live in them. So it's going to further take rental properties off the market. So all these things are really constraining supply of rental housing. Okay, extreme constriction of supply. Now, what about on the demand side? Well, there's already a housing shortage, and now that the mortgage rates are high, people that would be, say, coming out of a rental and transitioning to homeowner status with rates as high as they are, they're going to stay in the rental market longer, right? They're going to stay renters for longer. So there's no shortage of demand, and there's no draining out of that pool of demand because rates are going up. And at the same time, rates going up makes supply more constrained. So it's almost like a perfect storm for the person that owns rental property. There's going to be a lot of people wanting to rent your property, and you're going to be able to keep your rates high. So we have one investment in our portfolio called Invitation Homes, and they own single-family residences that they buy and hold as rental properties. Okay, and there's another investment vehicle that we may be talking to you about that also has a big portfolio of, in this case, is multifamily housing. And it's done quite well, and it's held up, and the portfolio looks pretty good because it's a harder and harder sector to get into, right? So if someone's already in, they have an advantage because of the financing costs going up. So that's something we're looking at to kind of find a place to diversify the portfolio and lower the risk and maybe get a decent return, to carve out a little bit of allocation to housing, whether single family or multifamily, and we could do it through a securities account. So just want to give you an update. The inflation report wasn't good, and we're taking that into consideration as how we manage the portfolio, and we're looking for alternatives to preserve and grow and hold the value of your wealth. Okay, so hope that update helps, and just be encouraged that we'll get through this, and we're doing our best. Okay, have a great day.